Hello, everybody. Thank you so much for joining us today. You've tuned into the biggest debate of the mutual fund industry, active versus passive mutual funds. And today, I'm not going to host the show. Yes, I'm not going to host the show. Today, we have a very special host, especially for y'all. Mr. Anshuman Sharma is joining us. He has a huge presence in the creator economy. Anshuman, thank you so much for joining us today. You have a previous experience in the mutual fund distribution, and thank you so much for joining
Hi,
us today
Zoe.
on the
Hello.
spaces.
It's my privilege, and you're very kind. Thank you for the kind intro.
All right. With Anshuman Sharma as co host, we have Rajit Tandale, who is the Senior Vice President Mutual Funds. We have Mr. Jeet Marwari, the founder and MD at One Finance, and Mr. Keval Bhanushali, co founder and CEO at One Finance. Anshuman, you want to go ahead and introduce our important speakers for tonight, please?
For sure. Hello, guys. Welcome to today's session. Firstly, the topic. Today's topic is something which everyone is curious about. The biggest debate of the of all the equity investors in India. Which is better, active mutual funds or passive mutual funds? And for a topic like this, we need a panel with a lot of heavyweights, and that's why I'm very really excited to be hosting this, because today we have a lot of great speakers who will be spending some time and sharing their insights for the next 1 hour. Firstly, the first guest of tonight is Ashish. Ashish Somaya is the CEO of White Oak Capital Management, and he has more than 20 years experience in the mutual fund industry. Welcome, Ashish sir. I hope you're doing great. The next guest for today is Pratik Oswal. He heads Motilal Oswal's passive funds business. He has prior experience in investment banking, private equity, and hedge funds. We also have Pratibha Giri, the founder of FinWise Personal Finance Solutions, and Binoli Jain, co-founder and CEO of MoneyMart. Welcome, guys. How's it going? Hi, Pratik. How are you?
Hi, Anshuman. Thanks for inviting me and Ashish and everyone, and looking forward to this conversation today.
Great. What about everyone else, guys? Hi, how are you doing? How's everyone doing?
Anshuman, I'm so sorry
Hi.
to interrupt you. Uh, Sonam, can you check? Ashish has not received a request. He
I
was.
have shared a request, Rajni. I'm waiting for him to accept it. Ashish, sir, if you've not received one from my end, you can also request it from your end and I'll accept it, please, sir.
Till Ashish joins us, we'll start the conversation with Pratik. Pratik, I see that you have prior experience in private equity and hedge funds. I'm really curious how you were able to switch from something which is very, which requires a lot of your time and a lot of active management to the passive side of the business.
Thanks. I would say that if you look at my last 10 years, I actually spent the first half of my 20s in more sort of traditional finance, investment banking, private equity, hedge funds, and then the second half of my 20s in tech. So before this, I was in San Francisco Bay Area, working for tech startups, and now I'm sort of doing both together. But while I was working for a tech company in the Bay Area, I was in a wealth management startup, and I was exposed to a lot of client portfolios. So we had about 800 to 1,000 ultra HNI investors, and these are investors who are investing upwards of $25 million plus. And I saw that I think if you look at all of their portfolios, I would say roughly about 40 to 50% of the portfolios were invested in, say, passive funds. Approximately, say, 20 to 30% of their portfolio was invested outside their home country. And when I came back to India in 2018, I saw that no one was really talking about passive funds. No one knew what passive funds were, and I also saw that almost no one had any international allocation in their portfolio. So I thought that could be a good way to propose to sort of get involved, because what we've seen, at least historically, is that there is a, I would say, 5 to 10 year lag between what really happens in the US versus what happens in India. So that's how I sort of thought that this is a good gap in the market. So that's number one. Number two, also I thought that I think mutual fund investing is sort of complex, for the DIY investor. So anyone who's looking, and we have had a huge sort of flurry of new investors coming in the last couple of years, especially post pandemic. And a lot of these guys are first time investors. So I really think that if India wants to grow to that 30, 40, 50, 60% of the not that high, but if India wants to go in line with global standards where there's more and more equity adoption, passive funds make it super easy and simple. So that's how I sort of, got into the space. And yeah, you're right.
Yeah, I see. Like the entire equity landscape in India has transformed massively in the last 10 years. My co-host Rajni has close to 15 years of experience in the asset management space. Rajni, what are some of the changes that you observe in the last 10, 15 years in this space?
So, first of all, thank you, Ashish. Thank you, Prateek. So glad to have you on this platform. Thank you, Pratibha ma'am. Thank you, Binoli, for joining us. So, Anshuman, let me just first explain, for everybody's benefit, for the audience, what exactly is active and passive. So, active is, in very simple words, there's a basket. The fund manager is trying to create a small basket and trying to pick out of the bigger basket and creating a small basket portfolio with all their research and strategy and actively managing the smaller portfolio. This is active funds. And whereas the other side, the passive fund, without any research, completely buying the entire basket. For example, if it is a Nifty 100 is a basket, the active fund manager pick and choose the funds and create 20, 30, 40 stocks portfolio and continuously manage them. Whereas on the other side, the passive, the entire 100 stocks in the portfolio and without any research, managing them. So this is the basic difference between active and the passive one. To speak about the trend right now, I'll try to give a few numbers about the Indian numbers as well as try to compare with the US market too. So in India, we are close to 40 lakh crore of AUM as of now. Passive AUM is close to 6 lakh crore, roughly about 15% of market share we have, and close to 300 funds we have on the passive side. Whereas if I compare the same with the US, we have 10 trillion US dollars AUM. 49% is the share market in the US right now. And if you look at the trend of past 4 years in the US, the passive is positive of $2 trillion in past 4 years, whereas the active funds are negative with 855 billion. So this is the trend right now between the active and the passive fund. And if I look at right now, I see there's a lot of conversation going on, about the active and passive. They've become groups, completely anti-active funds, and started talking negative about active funds. So it's always been pitched that passive funds over the active funds. So my question is it just the trend which is coming from the Western countries, or actually active funds are underperforming the passive funds? My first question is to Ashish. Ashish?
Yeah, hi, sorry. Can you repeat your question if you don't mind, Rajni, please?
So my question was, Ashish, we see this trend, active versus passive. There's a lot of discussion going on. It's always been pitched passive over active these days. So is it just a trend of the market, or is it actually active funds are underperforming over passive?
See, there are multiple drivers to this. It's a very, very frankly, very difficult to make a conclusive statement. There are many nuances to it. So let me just dive into it. I think somewhere you also mentioned, you took an example of US and the data. So personally, if you ask me, I don't have any favorites. In fact, I've had the opportunity to create a lot of passive funds in a previous life. But the point is that the moment we start discussing US, we need to first understand that India is not US and nowhere close to becoming US. In the US, the most prevalent story is that money is moving from active mutual funds to passive mutual funds. That is half the story. The reality is that as much and more money has moved from active into alternates. So let me give you an oversimplified example. Just imagine that active mutual funds are Coca-Cola. So if I tell all the retail investors that Coca-Cola is not good for you, please have just soda. And if I tell all the wealthy investors that I'm happy to sell you concentrate, that is what it would actually tantamount to. Because in US, what has happened is you are told that the market has become efficient and institutions are big. The fact is not just institutionalization. The fact is that institutions put 60% of their money into private markets. So in US, the common story is that active funds are underperforming and active funds are not generating alpha. The reality is that the alpha has migrated into the private markets. So if Uber gets listed at $75 billion market cap, obviously in the public market, no alpha is made. In fact, money is lost. But if 75 billion market cap is where it gets listed, then obviously a lot of alpha went into the private market. So two, three things to keep in mind when you speak about the US. First is that yes, there is institutionalization. And yes, active funds are finding it difficult to generate alpha. But the reality is that it's not that there is no alpha. The fact is that alpha has gone into the private markets. Buyout funds, private equity funds, crossover funds, SPACs. This is where the alpha has gone. So the institutions and the private investors are making a lot of alpha and the public market is struggling. To support this, there's just one more data point. In the US in the last 25 years, the market cap has gone up 3x, but the number of listed companies has become half. So the playground for the active investors in the public market has shrunk quite dramatically in the US. Now you come to India. India is not US. In India, the number of listed companies is rising by the day. Bulk of the
Right.
economy is not reflected in the market. So where is the question of the market getting reflected in the index itself? So I think whenever we discuss active and passive, if we draw reference to US, then we should always qualify it with all the structural differences in the US market and the Indian market. That is one. Second thing, in recent times, of course, there is a lot of concern about active funds performance, but you should also understand that when the economy shrinks, meaning that 2019-20 India's GDP growth was 3.7% and 2021 it was negative. What do active managers do? They are trying to buy businesses which grow their revenues, profits, cash flows, whatever it may be. So when economic performance becomes very, very narrow, obviously corporate performance becomes very, very narrow. This is not today's story. Even if you take 2002, 2003, for a brief period, active managers struggle to beat the benchmark because even at that time, our economic growth was very, very narrow. So if you ask me, there are many things going for passive, like simplification, ease of decision making, providing Lego blocks to asset allocators. So there are many things which are going for passive, but when it comes to alpha and beta, making conclusive statements is difficult because we have to see market structure differences if you are drawing comparison with US, and you also have to pay heed to economic circumstances. And third, you also have to pay heed to how much is our economy developed. If the market doesn't capture the economy, then don't worry about index capturing the market.
Perfectly well said, Ashish. Just wanted to add here, we saw the S&P Dow Jones report yesterday, the half-yearly report of Indian, active versus passive funds. Again, we saw the data. The major effect is on the large cap side, and if you look at the mid and small cap, it's still doing better. So, how do you look at this data? Is it mostly the large caps are getting affected?
Yeah, I mean, see, two, three parts are there. One is clearly that if you see the large cap space is very, very tightly defined, right? And it is also stands to reason that when I mentioned that our market doesn't capture our economy, obviously that may not necessarily apply because what is there in the large cap space? Large cap space is IT, ITES, energy, commodities, power, those kind of public sector banks, big auto companies, those kind of things. Whereas all the action, I mean, whatever is the, whether you talk about, reforms, whether you talk about the growth in consumerism, whether you talk about consumer tech, fintech, or whatever new areas you talk about, or even the government's PLI or anything you speak about, everything, the action is in the mid and small cap space. And the unfettered mandates for managing active portfolios are also in the mid and small cap space. So small and mid cap by definition, for multiple reasons, small and mid cap by definition will be the happy hunting ground for any active manager. And I completely agree that, large cap funds have struggled. But I would again repeat one more thing. Apart from all these things, please do keep in mind that when economic performance is very, very bad, active managers will struggle. So that you must, when you look at data, you should try to think how much of this is, economic stress and how much of this is a long-term trend as to, as regards alpha generation.
Perfectly well said. Keval, you'd like to speak? Yeah.
Yeah, firstly, of course, thanks, Ashish. I think you summed up a lot of points. My only question to Ashish, it's a follow-up question. It's basically about when you mentioned that in US, there are new companies that are getting the number of companies on the secondary market or the public market are getting reduced day by day because most of the money is made in private market. But ain't that the same case even in India of late? Because SEBI has allowed a lot of new companies to list in. So there are two questions that I want to ask. One, uh, how comfortable or buoyant are active fund managers to actually include the new stocks? Because if you look at it, it's always going to be that top 40, 50 stocks that are there in everyone's basket, right? You're going to be 5, 10% here or there in allocations, and eventually everybody is making that same kind of mix and match given the limited options that we have, right? Irrespective of 5,000, 7,000, whatever stocks we have listed, the actual number of quality stocks that you have, because most of the active fund management is on that research philosophy. So that definitely reduces the number of stock options. So do you see that as a problem, and do you think that with new age technology companies being listed, even though they get a lot of beating when they come on the secondary market, but do you see that revival helping active fund managers in future, or do you think that active fund managers will stay or steer away from these kind of stocks for near future as well?
See, one thing is that there'll always be good performing managers and not so good performing managers. तो वो तो होते रहेगा. But on your question, I think that why just look at new age? Take a simple example. The first insurance company itself, I mean, insurance in some places is bigger than banking. If you take stock markets, in some places, insurance could be bigger than banking. In India, the first insurance company got listed barely 4 years back. If you take diagnostics, so actually, kya hai? It's not just about new age businesses. The fact is that bulk of our market is not listed. What is coming for listing? I mean, somebody making shoes is getting listed now. So I think that's the long runway. If you take the Chinese stock market, the biggest weightage in the index is consumer discretionary. In India, it is less than 10%. So, like the Manyavars and Campus Activewear are coming to the market now, right? So it's not just new age. The fact is that vast parts of our economy are underpenetrated, not listed, not yet explored. That is one. Second is obviously mutual funds. Last 5 years is when the corpus has gone up 10x. So you can definitely blame fund houses saying that did your strategy scale when your AUM scaled? Correct? That definitely you can throw a question to multiple CIOs, and you will find that in some cases, when the AUM scaled, the strategy didn't scale. So let us say we have now 30 analysts covering some 600 companies. So that is what we are doing now. I'm sure everybody will do it.
Great.
Absolutely. Great. So my question is, how do you look at expense ratio? Because there's a lot of talk again on the expense ratio. There are high expense ratios are being charged. We see on an average 1 to 2% of expense ratio charged on the active side. But do you think this is the reason for the underperformance or not beating the benchmark? Ashish, yeah, Pratik, both of you take it.
Yeah. Pratik, you want to go ahead, Pratik?
Yeah, sure. So, so basically, I mean, on the expense ratio, I mean, I just want to say that this, I mean, it's important to have a very balanced, view when it comes to a debate. So I definitely think that obviously one of the biggest selling points, or one of the positives of obviously investing in index funds and passively managed funds is the fact that you have an expense ratio, which is a lot lower. That ensures that more of your money is obviously invested in the underlying stocks. But also you're also to understand that this is being invested in an index, so there is no opportunity for you to outperform or have a specific strategy that's in your portfolio. So suppose you want a strategy where you want to only say invest in a few quality stocks or a quality basket, then it's much harder to do it in an index fund as opposed to an actively managed fund where someone's actually looking out for you in terms of what stock to buy, what stock to sell, which is why obviously expense ratios of actively managed funds are a lot higher. But I also feel like India as a country, the good thing about, at least from an investor perspective, is that we already have one of the lowest expense ratios, at least in passively managed funds. And this is probably on par, in fact, maybe a little bit lower than what you will see in global standards. So, if you look at Europe, or if you look at certain, at least in the US in the last say 4 or 5 years, it's a lot higher in terms of what you would see in expense ratio. So I think one good thing about I think passively managed funds is that you are obviously more of your money is invested. It's also important for investors to recognize that even passively managed funds, the mandate is to match the benchmark, or is to make sure that your returns are as close to the benchmark as possible. But obviously, you won't have a fund which will outperform the benchmark. So a lot of people have this misnomer that if I invest in a Nifty 50 or a Nifty 500 fund, then I would basically make the same return. That's not true, actually. So it is there is a lot of, not a lot, but there is still a little bit of inefficiency there, and you would obviously underperform the benchmark by a small amount, and that sort of term is called tracking error, which needs to be tracked. So a lot of investors who are looking at passively managed funds, I think it's important to look at that before you're investing into index funds, ETFs, whatever it is. So I think that's something I would say is very important.
So Pratik, I would come back to the tracking error part and the expense ratio of the ETFs and index funds. But before that, I want to, on the active side, out of 18-19 lakh crores of AUM, what we have, 60% is getting invested in only Nifty 50.
Yes.
So is it still fair to charge 1 to 2% expense ratio? But in fact, I saw some of the funds are charging up to 2.7%. So is it fair on the investor side?
So one, and this is something of a mutual fund industry thing. I think there's two actively managed funds, but you have to understand the expense ratio is a combination, of obviously the fees that are wealth advisor would charge for their services, in addition to what an EMC also charges. So combination of that would lead to the expense ratio that they would charge the customer. And I think it's very important to have that, because if you did not have actively managed funds for the first 20-30 years of at least since the mutual fund industry started, you wouldn't have an industry, because you have to. It's a product in India where unlike the US, where it comes in your as your retirement sort of solution. In India, you still have mutual funds. The reason why we have relatively okay penetration is because of the incentives aligned. So it's very important that yes, that obviously leads to lesser performance, because you are obviously taking out that from your investing, but it also leads to a framework where you have an entire ecosystem of advisors and distributors out there who are making sure that customers are investing in equity products and creating wealth. I think that's very important. When in terms of underperformance, I think one just thing I just want to talk about, which is very important. So people, at least when people are talking about active and passive funds, they talk about underperformance. But honestly, the biggest problem as an industry, and if you look at data, that we are, at least in my case, what I sometimes struggle is to convince customers to stay in for the long term, is to convince customers to invest for 5, 10, 15, 20 years. If you look at the actual data, and we've actually calculated this at the AMC as well, an average customer today, if you look at the entire mutual fund industry, in at least the equity funds, makes a negative alpha of about 5 to 6%. So an average investor in India today, if the index is doing 12% or 11% over the last 10, 15 years, an average investor is about 6 to 7%, and that gap is huge. And I think regardless if you invest in an active fund or a passive fund, I think that is the issue that needs to be solved, and that's where really you really need a lot of people to go out there and and educate and make sure that people are investing for the long run, and they're not doing stupid things like selling early or buying at the top, or selling at the bottom. So I believe that I think the behavior gap is what it's called is probably the biggest enemy at this point.
Ashish, I have one question for you. If you look at the large cap segment, I have the S&P index versus the active funds report, and in the first half of 2022, 87% of all active managers underperformed the benchmark. If you look at the last 1 year, 3 year, and 5 years, 90% underperformed over the last 1 year, 83% active funds underperformed over the last 3 years, and 89% underperformed the Nifty 100 index over the last 5 years. So in this segment, the large cap segment, which only has 100 companies, do you think investors should pay a commission and invest in an actively managed fund?
So Anshuman, क्या होता है? If you take this CAGR, in my opening remarks. First of all, I have no reason to bat one way or the other because I have been deeply involved in active, passive, PMS, mutual
True.
fund, all sides of the industry. Okay. But first thing is that when Rajni asked me in my opening remarks, I clarified one thing. I actually don't know how much of the underperformance is because of poor economic growth. Because if you see, take an example of 2019. In the index, only Reliance and ICICI worked. Nothing worked. And in that year, our economic growth was 3.6 or 3.7%. Next year, negative growth. So क्या होता है? Right? And now you take 2022, for example, beginning of 2022. I'm not giving this as an excuse, but the reality is that a lot of things which worked in the market, like a lot of people don't want to bet on Ukraine war, and a lot of people don't want to buy energy and power. So you can always say that, okay, if that is 15% of the benchmark, you missed out. There are large Adani companies which are missed out. So there could be many reasons. I'm not here to give excuse, but take a simple thing that if you are telling me last 5 years, funds underperformed in the large cap space. Out of 5 years, 3 years we had anemic growth, right? So that means index would be narrow. Second important thing is that in the large cap space, I myself said that the universe itself is very, very narrow. I mean, it has been dictated that 80% of the money has to go in ABCD, XYZ stocks. Within that, also some maybe, depending on different people's preferences. So large cap, there is definitely a challenge. I'm not debating that. What you could actually do if you want more clarity on what I'm saying, don't look at last 1 year, 3 year, 5 year. Just do one thing. Stack up all the calendar years. The same data which you spoke, the same data which S&P presents, either you do it or you source it. Just stack up and see every calendar year. Don't see 1 year, 3 year, 5 year. Just see every calendar year how many funds outperform the benchmark. A calendar year, financial year, quarter on quarter, whichever way you want. See, take discrete periods. Don't take rolling data or CAGR. CAGR कैसा है कि पिछले 5 अगर मेरे पिछले 2 साल खराब हो गए ना तो मेरा पिछला 10 साल भी खराब दिखेगा और अगले 2 साल बढ़िया हो गए ना तो पिछला 10 साल का हिसाब चुका देगा. So CAGR can be misleading. So what you do is you take discrete periods and see how many in the last 20 years, how many years, what percentage of funds beat the index. आप ऐसे देखो आपको डेटा अलग दिखेगा.
True,
It will
true,
not look as bad.
True, but for investors who are confused between active and passive funds,
So sorry, I didn't know. Yeah. So
Yeah,
see, frankly, for an investor, from an investor's perspective, it is a no-brainer. If an active fund is not beating the benchmark, you should not be in that fund, and you should move into passive. वो तो see, that's why I'm saying. In fact, if you really ask me, alpha नहीं आएगा तो कोई active fund में क्यों जाएगा? वो तो no-brainer है. उसके लिए तो discussion करने का जरूरत ही नहीं है. In fact, I have always been saying that beyond alpha, there are 10 other reasons why passive funds would gain traction. Take a simple example, simplicity. Today I am entering the market, I have no clue what to do. I can just buy Nifty 500. Easiest way to get started. I want to invest in US, I don't know what to do. I can just buy S&P 500. Simplicity, ease of transaction. There are some people who believe that asset allocation is what matter. All this stock picking and funds and all don't matter. So they just, they just need Lego blocks to build whatever structure that they want to build. So passive funds are the best Lego blocks. So there are many things which drive passives. Alpha beta का जो discussion है ना, that is extremely nuanced. We can go on till tomorrow morning.
True. I have one question for the entire panel. One of the equity mutual funds में एक दो बहुत ही hero funds है. We can talk about HDFC Balanced Advantage fund हो गया, HDFC Top 100 fund हो गया, जिसके वजह से if someone invested, they will also recommend it to their neighbors and their friends, family, everyone. Why is it कि अभी तक like passive funds के बारे में discussion चल रहा है, everyone knows the advantage, but then if I have to go and search for a passive mutual fund, अभी तक ऐसा कोई फंड आया नहीं है जो सबको पता है, जिसके बारे में सब अच्छी बातें कर रहे हैं. So ये मतलब अभी वो मार्केटिंग क्यों नहीं हो रही है पैसिव फंड के बारे में? Please free to answer. Everyone in the
I think
panel.
Pratibha ma'am wanted to speak.
Pratik is doing a lot of marketing here.
I wanted to speak on the previous point, actually. I had a very interesting data which I read. One of the mutual funds had published a report with daily rolling returns over 1 year, 3 year, and 5 year periods, which category of schemes, how many times has it beaten the benchmark? Okay. And the interesting thing is, among all schemes, 62% of the time the active funds have beaten the benchmark. I'm not propagating that everybody should be active. I'm just telling you that this is the data which is thrown up for 10 years of rolling returns. Okay, 1 year, 3 year, and 5 years. In 5 years, 62% of the schemes had beaten the benchmark. In mid cap, 69.05. And in small cap, 86.21% had beaten the benchmark. So I think in India, this is the data published by Union Mutual Fund, is a research paper. You can have a look at it. There is a lot of steam left in active funds.
So my question here is to Jeet actually. So if you look at mutual funds, we speak about 40 lakh crore of AUM, uh, multi-folds from last 5 years, 13 crore plus folios. But if you look at unique data, is only hardly 3.5 crore of unique investors. But even if you remove the small SIPs, 1,000, 2,000 SIPs, I think only half of them will be left, 1 to 2 crores. So ideally, we haven't even scratched the surface yet, and we have not gone to the masses. So, Jeet, I would like to ask you this: ki, in case if we have to penetrate this mutual fund industry, since you have an experience of uh, rural, clients, what's your view on this?
Thank you, Rajni. I think, I mean, of course, India as a country, we have to really appreciate and understand the context of the demographics that we have. And of course, we're talking about the larger masses, right? So, first of all, I think the government and the ministry is doing a great job at enabling transactions to happen, direct transfers to happen for benefits and all of that for the lowest rung of the pyramid, right? And in terms of access, I think digitization is playing that role. I think, of course, with my background in the family business of Marwadi Financial Services, where we have served around 4 lakh customers in the semi-urban and the rural parts of Gujarat primarily, we know that Indian people are savvy with money. It's not just the Marwadis or the Gujaratis. I think they're very smart in terms of managing their money. Of course, they may not have the access to some of the smart tools or sort of ways to grow their wealth in a way that the last couple of decades has seen in terms of a lot of things, right? So I think to grow that access, of course, education, a lot in terms of focusing on making it a public good in some sense. Investing becomes so that's where mutual funds comes in, and I think as an entry point, like Ashish also mentioned, you can start simply. You don't have to think too much. You don't have to worry about mis-selling. I think that's a great starting point, in my opinion, for someone who has, of course, roti kapda makan. And yeah, that's my 2 cents on that.
That's so well explained, Jeet. My next question is on the commission part. Actually, we speak a lot about the commission. So, Ashish, I would like to ask this: ki, is it right to charge, give commissions to the agents? What's your view on this? Can we have only direct scheme instead of regular?
See, I think क्या होता है, a lot of times there is this comparison of regular and direct.
Right.
Actually, if you're on the wrong train, the speed is irrelevant. So what happens is that a lot of times after having entered a fund, people will say, oh, if I was in direct, I would do this. If I was in regular, I'm doing this. But the point is that in India, who got people into a mutual fund? See, agents and distributors, their only job in life is not to enable comparisons of direct plan and regular plan. Their job in life is to first get the customer. And a third party is worth a lot. So whether it is commission based or fee based, third party, see, if you come to my office, I'll say White Oak is God's gift to mankind. Kuch bachta hi nahi hai fir to. But the point is, people need a third party. And for whatever it is worth, a third party will always be better and less predatory compared to a manufacturer. So there is a space for intermediaries. Now the question is, should they be paid commission? Should they be paid fees? I would leave it to the investor's choice, right? But I feel that the bigger role in a country like India in last 20, 25 years, the biggest role that mutual fund distributors have played is first to get people in. In a country where people lose money in the Rose Valleys and Sardas and the plantation schemes of the world, it is futile to debate whether people should be paid 0.5% more or 0.5% less. The regulation, when we discuss all of this, we have an availability bias. because there is an industry which is regulated and because there is a bunch of people who are transparent, you are regulating what is available, but you're turning a blind eye to the data which is not in front of you. So in a country where, I'm repeating, but in a country where people lose money to unregulated things, it is futile to debate whether somebody should be paid 0.5% less or more. Their biggest contribution is to get investors into the capital market, and to get investors into the capital market via a regulated product. I think that is the crucial part. After that, one can keep debating whether it should be direct plan, regular plan, commission, or advice. And I don't think everybody is capable of making all the decisions. I don't think investors left to their own means are going to be persistent about their. Nobody wakes up in the morning saying, I want to invest in a mutual fund today, right? So intermediaries play a much larger role than what is usually discussed in social media or any other forms of platforms.
Very true, very true. Even if you look at the insurance business in India, for most people, LIC is not a company. LIC is a person who lives nearby and sells them an insurance, and at the same time is available for them. So that's why they trust the company, because they have seen a physical person coming to their houses and convincing them to invest or buy in this product. So in India 2 and India 3, the awareness is not at that level where we can just remove intermediaries. But at the same time, as the awareness is low, nobody knows how is the intermediary incentivized. In the case of a mutual fund distributor, they will make a little more money if the expense ratio of that particular mutual fund is on the higher side. So how do we solve for this side? How do we solve for the problem? How do we make sure that the incentives of the investor and the intermediary is aligned?
See, I think the regulator has done fabulous work on that for a simple reason that, first of all, commissions are disclosed transparently. Okay, so if an investor checks the statement, which comes every 6 months from CDSL, not from any mutual fund or any distributor, it comes from a centralized agency. It actually tells you in rupee terms, not even percentages. It actually tells you in rupee terms what your intermediary earns. So the transparency is of the highest level. That is one. Second important point is, it is caricaturish to think that distributors offer all the products which give them lots of commission. I'll tell you the reason why. Because in the last few years, the difference between the best paymaster and the worst paymaster of commission is few basis points. 10-20 years back, it used to be percentage points. Now it is basis points. And the last thing is that because the difference between the best payer and the worst payer is not so big, intermediaries know that they have to retain their customers. If they want to negotiate a commission, first they see who is performing, who is not performing, and then they will negotiate. They just don't go around negotiating with everybody. So, if you get a bad performing manager and you get 20 basis points extra commission, you lose the customer. Everybody knows this. It's an open market. So I personally feel that a lot of times when it comes to intermediation, there are a lot of theoretical or perception based or very caricaturish representations that are thrown out there. The regulator has done a fabulous job. The reality is very different.
Great. I think Binoli ma'am want to speak. Please go ahead.
Yeah. Hi, Anshuman. So
Hi.
I wanted to add 2 points over here. Okay. The first point is on the commission part. And just to take ahead what Ashish was just saying, that, tell me one industry where the distributor's gross payout on an average, on the money he manages is less than 1%. Okay. On top of this, we pay GST, we pay income tax. So the idea is that anyways, it's not that, the profits are handsome. Okay. And then we are giving top-notch service and technology to a client, that a client even sitting in Australia with a click of a button can transact, can buy, sell his investments. So if the incentives are decent enough, even a distributor would be willing to look at other options, would be doing more of passive. Okay, as Pratik also mentioned that the payouts to distributors in the passive space in India are lowest as compared to everywhere else in the world. Okay. The second point which I was to make is, even the passive space is not that easy. Today, when we say first-time investors should invest into the passive funds, But today, if I actually just go and Google how many type of passive funds are available, there is, other than Nifty 50 and Nifty Junior, you have momentum, you have quality, you have equal weight, you have low volatility, you have Alpha 50. So if a first-time investor was to invest into a passive space, also there is so much of confusion. I know of one AMC which has a separate fact sheet for passive funds. So that space is also getting crowded. If we have 700 active mutual funds, I think there are around 200 plus passive mutual funds, and the space is growing. So when again there is some advice which is needed to help a common man select which passive fund he should invest into. So this is also my representative presentation to the industry, that we are making passive space also very crowded and confusing for a first time investor to get into. Yeah, so that's for me.
Pratibha?
Yeah. So, thank you, Ashish. I think that discussion on the caricature of intermediaries was a wonderful one. Pratik mentioned some time back about the investor returns versus the investment returns. And that's a very telling point. There is a 5 to 6% difference between what the investor makes versus what the investment makes. This is where proper intermediary comes into the picture. One is scheme selection, asset allocation. Okay, these maybe you can manage, but the other major part in ensuring that the customer actually makes the kind of returns that the investment is making is managing behavior. I think there's no free lunches in the world, and if there is only direct schemes, you will see a lot more people making far less than what the investment is making. So this hand holding takes you need intermediaries to do that. They need to be paid accordingly. That's number one. Okay, number two is it's not simple. Okay, most people think it's simple, and we are talking about a very small maybe minority of people who are very well read, who are confident to come and invest directly into the market. Many people are worried. You'd be surprised that somebody who can afford to have an 70% allocation to equity has 20% allocation because they're worried about the volatility. This is again where value add is humongous. Don't look at the 0.75 or 1% which you're paying. Look at the kind of value add which one can make by just tweaking your asset allocation, by ensuring you stay invested, by giving you the confidence that mean revision will happen sooner or later. Yeah, that's it from me.
Pratik, what's your take on this?
Yeah. Sorry, I'm having network issues. So, I actually absolutely agree with Pratibha. I think, and I've always been a big proponent of taking help when it comes to investments. I believe, and I've actually personally seen portfolios, hundreds and hundreds of portfolios of a lot of DIY sort of investors, and it's honestly like my only advice to all of them, and I would say maybe 70-80% of them will not have proper portfolios. They've invested in very random funds. They've invested like the cash flows are not very consistent. I've seen portfolios with 20, 30, 40 mutual funds. So I do believe that India as a country is still getting exposed to equity as an asset class, and I mean there is if you look at I would say 99.9% of HNI investors or in family offices or institutions, they all have consultants. So some of the most sophisticated investors in India, have consultants, have wealth managers, not have one, but have multiple wealth managers. So I think it's important that someone who's coming for the first time, or at least someone who has access, or who can have access to an advisor, should ideally get use of it, because investing is very complex. To be honest, I think. You have to invest, and more than I think selection, the biggest sort of benefit of having an advisor, or having someone who can guide you, is the fact that they'll actually help you really manage your emotions during periods of stress. The biggest problem with equity investing is not really selection. Honestly, if you invest in any equity fund and hold on to it, any decent equity fund, active or passive, hold on to it for 10, 15, 20 years, you'll do really well in terms of wealth creation. But the problem happens when investors left for themselves. They really make poor decisions. They sell their investments when periods are bad. Ideally, the reason why equity investing is tough is because higher risk. There's higher return, but there's also higher risk. And a lot of investors try very hard to get higher risk, high return, but they like to avoid the high risk by trying to buy and sell at very ad hoc times, or they get attacked by greed when markets are going up,
or they get attacked by fear when markets are down. So I think having someone who's experienced can really help, because honestly the biggest wealth creation comes from compounding, not from trying to select which fund that comes in, and that really requires time and effort, time in the markets, and it really requires you to feel the pain when markets are bad, and try to sort of hold yourself when markets are good. So I think overall, I think if we did not have fees, or if we don't have advisors, the mutual fund would not be even 10% of what it is today. So I do believe that it's important, and most people should I recommend most people to go out there and get advice.
Ashish said that the biggest advantage of investing in a passive fund is the ease. Like, you just have to pick an index. But right now, if we, as Pratibha mentioned, we have more than 200 plus passive funds. So, इतने तो मतलब indices अगर 5-10 है, so why does this market currently have so many index funds? We are going back to the same state of confusion.
Yeah, no, that's true actually. So the whole idea behind launching passive funds. So we were with obviously I think Ashish and I worked together, and we were both involved with building up the passive business, and the whole idea was to create supply, create new categories. Back in 2019 there was no mid cap passive fund, there was no small cap, there was no multi cap passive fund. In fact, even international funds were not heard of. So the idea was to obviously create awareness and supply. Now obviously, and now you have the opposite problem where there's too much supply, too many options. So I do agree with you that I think complexity has increased even in passive. The whole idea about investing in simple products has become also slightly complex because there's so many options. But I do believe that even though there's so many options, there are that. I mean, if you look at the really, I mean, when most people think about passive, they think about Nifty or a Sensex or a Nifty 500. But actually, passive in a sense means a fund that is tracking an index, and the index can be anything. It can be an equity index, it can be a debt index, it can be an international index, it can be commodities, it can be thematics. So I think, and if you look at the US, I mean, the bigger mutual funds have hundreds of passive funds with them in the portfolio. But I do agree. I think complexity is there, which is why if you are looking at least from an investor standpoint, still I think if you look at where flows are coming in passive funds, they're coming in fairly simple products. I'd also like to say that there's not a lot of difference between a Nifty 50 fund at one AMC versus another. They're almost the same. So investors don't have to be overwhelmed by the choice of Nifty 50 funds. There might be maybe 25, 30 funds in the market today, but all are very similar. So the idea is to go with someone who you trust, someone who you're comfortable with, and the returns are pretty much going to be the same, at least today. So that's some I think thought.
Keval and Jeet, you guys wanted to say something?
Yeah, Jeet, you want to go first, or maybe?
No, Keval, go on. You have had your hand up for too long. Your hand must be hurting.
Yeah, so actually, I mean, I was just circling back to Binoli's or Pratibha's question that may not be, I mean, it may not be very pleasant though. My only point is like, no, where have we in the world seen that you're going to say that when she mentioned that 1% of AUM and all that as a commission, that's like my real estate agent asking me 1% of my flat value every year. Right, and that too compounding it with and charging me on the growth also, right? And when we talk about managing actively, we don't really need that level of management, like AMC भी charge कर रहा है management fees फिर. So I mean, my only point is that since advisors claim to be the actual wealth creators and all that stuff, shouldn't that fee rather be linked to performance? Then because I have just one of our colleagues, we recently did their financial planning and all, and we saw that she was investing 4 lakh rupees a year, but since she was investing since 10 years, now her annual commission is almost 55,000 rupees a year, which is like a whooping 12-13% of her annual investment. अब 12-13% तो उसका जो annual investment है उसका CAGR भी नहीं होगा. So, I mean, shouldn't that there be some kind of linkage? And if you look at her overall CAGR till date, it is still somewhere around 10-10.5%. I mean, so I really don't think that that's fair, and probably I'll leave it open to all the participants here. But since that was brought up that it's 1%, that 1% when compound, it's actually become too high in my opinion. I mean, that's just a very nominal opinion that I have.
See, I think Keval, what will happen is you are right, but so two things can happen. One is people can go for a fee-based planner rather than go for a commission-based. So that choice the regulator has brought in, and that is available and that is out there. Second thing to keep in mind is that आप समझोगे उसका 10 साल में 4 लाख का वैल्यू हो गया, 20 लाख, 25 लाख, 30 लाख, कुछ भी समझो वैल्यू हो गया, आप फिर भी 4 लाख पे बता के बोल रहे हो कि 12-13% हो गया. The point is that what role the distributor plays or doesn't play.
Sorry 4 लाख पे नहीं बोल रहा हूँ, 4 लाख रुपया एनुअली यूज कर डाल रहे हैं और ओवरऑल AUM हो गया कुछ अराउंड से 50-55 लाख. तो एक तो 40 लाख का 50 लाख, मतलब you're getting it, like उसका अगर
no, it can't be na. If somebody has been investing 4 lakh rupees every year
as in
10
as
years,
in compounding, I'm saying compounding आज की तारीख में 4 लाख रुपया इन्वेस्ट कर रही है, she's been increasing it.
See, it's like this, very simple. The commission is 1%. That whether the investor wants to pay, doesn't want to pay, उसके तो बहुत choices create हो गए, because you can go direct.
तो उसका performance, my only point is that advisor performance based लेना चाहिए ना, right? Like अगर जो 10-10.5% का CAGR लेना है, उसमें 2-2.5% AMC भी लेगा, 1% advisor भी लेगा.
No. 2-2.5% AMC का होता नहीं है. All large funds are in the range of 1.5 to 1.75%, and the commission paid to the distributor is subset of that 1.5 or 1.75. It is not additive. It is one and the same number. It's a subset. So what I'm trying to tell you is that there is abundant choices available. That customer can go direct. That customer can go to a fee-based planner and pay performance linked, pay flat fee, pay whatever. They can go to a fintech and pay nothing. So all those choices are available. There is nobody who's forcing anybody that this is the way you should do it. That is one thing to keep in mind. Second is, just let me finish. Please understand one thing. There is a cost of servicing someone. A म्यूचुअल फंड डिस्ट्रीब्यूटर हो चाहे फाइनेंशियल प्लानर हो, एक आदमी आपको क्या लगता है कितने कस्टमर को टैकल कर सकता है? सेकेंड थिंग, इफ द एवरेज इज 3,000 rupees per month per SIP, that is the industry's average, right? There are crores and crores of folio. You tell me one thing, if a guy is investing, the average investor 3,000 rupees per month they are investing, so 36,000 rupees per year. हर आदमी का एक SIP नहीं होगा, 2-3 SIP होगा. So the average investor is putting 1 lakh rupees per year. 1 lakh rupees per year gives the distributor 1,000 rupees per year. आपको क्या लगता है एक डिस्ट्रीब्यूटर कितने कस्टमर संभाल सकता है? सी, ये जो चीजें हम बात कर रहे हैं, all these experiments have been done in UK. There was a retail distribution review in UK done 20 years back. Their net conclusion is that retail investors have been left in the lurch. There is nobody who wants to service retail investors. That is the situation in UK as of today, based on these very same thought considerations. So there is a reason why something works and something doesn't work. If you say that people who are investing 1 lakh rupees per year, they should go to a fee-based planner or they should pay performance link fee. बस 1 लाख का अगर साल के एंड में 1,10,000 होएगा, परफॉर्मेंस लिंक्ड फी होगा उसका समझो 10% ऑफ द परफॉर्मेंस या 10% ऑफ द अल्फा. इंटरमीडियरी को क्या मिलेगा? व्हाई शुड द इंटरमीडियरी इवन बॉदर विद द रिटेल इन्वेस्टर? अगर इस तरीके का सोच हम लोग रखेंगे ना, तो रिटेल इन्वेस्टर्स विल बी लेफ्ट इन द लर्च. नोबडी विल वांट टू सर्विस रिटेल इन्वेस्टर्स. दिस इज ऑलरेडी हैपेंड इन द वेस्टर्न वर्ल्ड. इट्स नॉट माय थियरी व्हिच आई एम टेलिंग यू. देयर इज लिटरेचर ऑन दिस. यू कैन जस्ट गूगल अप UK रिटेल डिस्ट्रीब्यूशन रिव्यू लेटेस्ट फाइंडिंग्स. आप गूगल करके पढ़ लीजिए.
तो लाख रुपए वाले को तो ऐसे भी, I mean 1,000 rupees के लिए, do you think that the level of service is there actually? That's the whole point.
आप अरे तो you are arguing against the reality. What is the reality today? The reality today is that there are crores and crores of SIPs which distributors are servicing. That's a fact.
But that's exactly the point, right? When the market fell, there was a huge redemption and the stoppages of SIP because most of them were not psychologically aligned and probably not that level of probably
I'm
emotional
sorry,
support.
you will have to define. नहीं huge means क्या होता है? आपको इंडस्ट्री का SIP का डेटा तो हर महीने छप के आता है,
right? So I think there was some numbers which Rajni, I think we had seen. What was the discontinued number?
Irrespective of whether you pay fee or commission, some people will get scared and stop the SIP. That is nothing to do with the revenue model of the intermediary.
No, that's about the servicing part. No.
See, the example which you gave, कि भाई मेरा 50 लाख रुपए का इन्वेस्टमेंट है, तो उस पे मैं 1 लाख रुपया फी क्यों दूं? उसको डेफिनेटली फी बेस्ड प्लानर के पास जाके फी कम करना चाहिए. उसमें तो कोई डिबेट नहीं है, because it's a commercial discussion.
That's the whole point.
Yeah. But the point is that if you apply that logic, हाँ, I agree. वो तो करना चाहिए. But the moment you start applying that logic to retail investors, they'll be left in the lurch because there is
Probably,
a
yes.
bare minimum threshold for servicing someone.
True. That is totally agreed. Jeet.
Yeah, just a quick sort of. So, I think we need to separate a distributor from an advisor here for all, I mean, all parts of the society, whether someone who's paying 1,000 or saving, 10,000 a month or 5,000 a month. Uh, so, a distributor is someone who provides access. So, the service there is essentially just how to get the mutual funds, right? And an advisor is someone who helps you select or who helps you stay the course in your best interest. So I think we need to, commission or no commission, flat or fixed, whatever the revenue model we're discussing, we need to also separate the advisor from the distributor, because that's where I see a lot of the challenge exists today for the investor, because the distributor becomes the advisor, and that's where I find a lot of issues, misalignment of incentives, misalignment of interest, lack of, I would say, lack of qualification or expertise. So this is something that I find, we need to really solve for. And of course, the regulation is doing a great job at making sure the interest of the larger average investor is considered, while at the same time being a supply-led, country with, so much supply of mutual funds and equity to ensure participation is happening. The distinction has to ensure that there is a separation, there is a way that different classes of investors get different ways of services where the incentives and interests are aligned. Of course, it's an open market, I understand that, but there's a lot more as a fiduciary that has to happen there.
Just wanted to add here, Ashish. So, last financial year, 1.1 crore SIP have been stopped, seized, or not renewed. So, this was the data we found. So, we realized maybe the investors generally stop their SIPs when they see the lot of negative returns, or maybe the
If
fund is not.
Rajni, how many, if somebody's SIP ends, that
Right.
also gets counted there. That is one.
Yeah.
Second is you should double check that 1.1 crore number, because the total number of SIPs itself is in the vicinity of 5 to 6 crores. So last financial year, there is no reason for 20% of those SIPs to stop. You should double check that data.
Sure. I'll definitely recheck this data.
We'll move on. I have a question for Prateek. I recently read your article where you said that you do not invest in passive funds. If an investor is looking at this one in data or insight standalone, then they'll be like, if the head of a passive funds business has no skin in the game, then how do we gather the confidence and the courage to invest in this? ऐसा लगता है कि शायद एक्टिव अभी बेटर है. That's why he is also investing in. So what do you have to say for that?
Yeah. I think there was an article in the newspaper which we talked about my financial profile. Actually, you know what? That was a misunderstanding. The journalist apologized. So what I meant in that article was that my allocation to passive funds was relatively small, because I've been investing for over, I would say, maybe 12, 13 years. And obviously back then there were not a lot of passive funds. Now they are. So I have been investing, but it's a very small proportion of my portfolio. Because obviously of the legacy effect. So that was just something which I just thought I'd put it out. But I'm not against passive investing. Obviously I do invest in passive funds. I invest in international funds. I also invest in active funds. So it's not like I have a bias towards each other. I think equity investing is what I sort of believe in. But I also feel that this conversation, there's a fair bit of confirmation bias also happening in today's conversation, where obviously I mean, this entire commission thing is something which I personally, and so do a lot of people out here, talk to distributors on a daily basis. And obviously, I mean, distributors are called distributors, but they're actually, I would say, a good proportion of them are actually advisors. It's just that due to regulations, they're not able to call themselves advisors. So I think that's a big thing that people should keep in mind. And again, as I said, globally, if you look at the US, if you look at many countries in the world, this is how essentially financial planning is not a one-time job. It's a one-time job, but then obviously you have to maintain behavior. You have to keep on servicing your client. It's a relationship that you have with a financial planner for a financial advisor or distributor for 1, 5, 10, 15, 20 years. So I think looking at that, it's extremely important that people do not think about distribution fee as a negative. I think you pay your doctor, you pay your lawyer, you pay your accountant. I think it's the same way. I think it's important that you also think of it in the same terms. In fact, in my opinion, financial advisor might be a lot more important, because by the time, because I keep telling people that I essentially investing is super important, because ultimately, if you look at, say, if you want to become wealthy, and this is, I would say, most wealthy people in the world have one thing in common. That is they own stuff. They own stocks, or they own real estate, or they own gold, or they own companies. They own companies. And I think wealth creation happens the simplest possible way through, say, a mutual fund, where you're getting ownership of companies that are obviously delivering profitability. So I do think that, and being able to leverage that to the maximum, I think it's obviously important to have that. I mean, if you obviously need advice, you want to have that yearly relationship with your advisor, because it's, as I said, it's not a one-time job. If it was a one-time job, then the whole world would be very different today. But I have worked in
Yeah.
wealth companies in the US and many parts of the world, and this is basically how the most successful model has been, at least from historical context.
My next question is for Pratibha and Binoli. Who should choose active and passive funds? And is there an ideal allocation between the two to optimize your returns?
I think passive funds, people who think, at least, people who think they know a lot, who have the time for research and a passion to research, passive funds are a good bet for them. They know where they should invest, they know their asset allocation, and they can find their way through the 300 passive funds which is there in the market, and allocate there. But one thing should be clear, whether you choose active or passive, it shouldn't be for the wrong reasons. I've interacted with many customers who happen to believe that passive funds are less volatile, or there's less risk involved. Ultimately, it's the same index, right? So either you'll get slightly better returns in the index, same returns, or slightly lower. The risk remains the same. So that understanding should be there. For everybody else who doesn't have the time, energy, and effort required is not there, then I think they should stick to active funds. And in among the market caps, obviously, if you have to choose that, I will use passive for some of the market caps. I would choose to possibly do large cap through passive, and do the rest through active funds.
So I would like to add over here, Pratibha. I think for international investing, passive makes a lot of sense. There are a couple of products in the debt space also, like in the current market scenario, I think target maturity fund as a concept. Even these kind of debt funds make a great investing option in the passive space. Commodities, if somebody wants to invest into gold and silver, even, they are great options in the passive space. So there is space for passive funds, and we cannot define an allocation in an investor's portfolio. But yes, a combination. We cannot say we will do only active or we'll do only passive, but I think a combination could be in the best interest of everybody.
Pratibha, you said that for people who know and understand the market better, a passive funds is a better way, right? But passive funds with we just have to choose one or two indices. Let's say the large cap index, एक benchmark ले लिया, एक mid cap passive fund ले लिया, and we are done. So what is the research here that you were talking about?
No, I'm not talking about the fund research. I'm talking about their own situation, whether the index which they're choosing is well suited for them. There are people, who want to invest in electrical vehicles, say. I mean, I don't know if it's available in India, but there was an event which was conducted where we realized that factor-based investing, you can just choose to invest only in electrical vehicles, or, pollution, non-polluting stuff. So, there you need to know what is required for your personal situation, for your financial goals to be met, what kind of asset allocation is required. I'm not talking about, which AMC, it'll be the same, right? You're tracking the same index. I'm talking about complete understanding of yourself and how you're going to behave when the index will not give you the required returns at some point of time. There may be underperformance. How you're going to, behave? Are you going to redeem, or are you going to not? If you have complete understanding of yourself, then maybe passives work.
Got it. Then the main argument here is probably not about whether you should go for an active investor, active fund, or a passive fund. The main argument is whether you need an advisor or not. because actively managed mutual funds, maybe you will need you have to make those decisions if you are investing in direct funds. So
Absolutely. Absolutely. Whether you have access to expertise, whether you want to pay for the expertise, if you think the price you're paying is too much and you want to do DIY, then passive, I guess, is also available.
okay, so now my next question is for my co-host Rajni. In this last 1 hour of the conversation, I am really confused. What is the differentiation between an active and passive mutual fund? If in the end, the better way out for an investor is to pick an advisor who is making those decisions. So how to go about it?
It's always, better to go with the advisors, I feel, Anshuman, because even if you are a financial expert, it's always advised to, I'll give you an example. Though you are a doctor, you will always go for another doctor when you're unwell. So same, it's my more personal opinion. It's always best to, give your financials to advisors and take a best advice from them.
Got it. Got it. Now I have one question for Keval. Like, what are some of the reasons why there has been, like you mentioned, that a lot of SIPs were stopped in the last 12 months. So what are some reasons for this?
Yeah, so in fact, even the last question, the point that I was trying to make is, when SIPs are closed or anything, what I personally have experienced that the gap that an advisor fills is not just of an financial expert but also of an emotional expert. So the most successful advisors that I have met in my life, they are the ones who assess and understand their customers psychology, their behavior towards money, and based on that advise them whether it is direct equity, whether it is passive funds, whether it is active funds. Because if somebody is by nature, they are extremely averse to volatility or any of such kind of things, it's always better to advise them appropriate products. And then some people have those, I think Pratik just mentioned about a bias, the confirmational bias. So all of us have all the top, five biases that are generally known, and it's just the degree of those biases that change. And it is very important to understand if somebody has that bias where they want to kind of always see themselves performing in line with the markets and so many other things, right? So I think that's very important. And the kind of SIPs that were stopped, though the data was unfortunately true, but the point is that that happens majorly. What I have seen is due to lack of an emotionally competent advisor and not just financially competent. That's my take on it.
Nick Maguli had said it once that the role that you do not go to church every week to listen to something new. You go to the church every week to hear the same thing and get that reinforcing in your head. Similarly, the role of an advisor here is to, whenever the market's going down and you're panic and if an investor is panicking, they will call the advisor and the advisor will talk about the role, the impact of investing for the long run. And that's the role of an investor. Like every time the market goes down, if you have a person who you can call and that person, if they convince you not to sell, half the battle is won there. Because money, as everyone said here, is made in the long run. It's not made in 6 months, 9 months. The investment returns might be higher in the 5-7 years, But if an investor is not invested for that tenure, then that data point is kind of pointless for them.
Absolutely. Anshuman, just one thing, I'll add to that point in terms of the advisor's role does not come only in the bad market where they are telling them equity best hai, all the years. They actually become more relevant in good years also. Like when the markets are peaking out, the best of the advisors are the one that will tell you even at times where not to invest. So that is something which I always urge a lot of advisors to do very actively, that if you know that this may not be the best time to invest, please be vocal about it. Don't just always say कि हाँ डालो. That's it.
True. It's been 75 minutes, guys, and अभी भी ये debate चलते रहेगा. I think we need 2 or 3 more sessions to find some conclusion. But I think in the end, इसमें कुछ conclusion है ही नहीं. That's the thing. In the end, what suits you better, you should go for it. And it's better if you have an advisor or someone who knows more about the market to guide you and stay invested. Thank you so much to all the listeners for tuning in. Thanks to all the panel members for giving your insights. If you are finding us for the first time, please make sure to follow all the speakers, follow One Finance. Thanks to One Finance for hosting this session. And yeah, goodbye, guys. Thank you so much.
Thank you so much.
Thank
Thank
you.
you all the speakers.
Thank you,
Thanks Pratik,
Anshuman.
Binoli,
Thank you.
Pratibha. All
My
of you.
pleasure.